Thank you, Rob. Good to see you as well. Been a while.
Yeah, good stuff. Good stuff. Yeah, we've got a more niche topic today. So I saw that the registration was a little bit lower than usual. So we're gonna have a nice smaller group, and maybe we'll keep this a bit shorter. We'll see. But nonetheless, I think this is good. I'm seeing a lot more people um, go for the floating rate option, whether it's on the bridge side or on the permanent side, where as we all know, a few years ago when interest rates were rising, everyone thought floating was a death sentence and you were an idiot. And so things have changed course with the steepness of the yield curve. We now have a pretty interesting environment to float in, which we can get into that as well. But this is a more specific discussion today, talking about interest rate caps, which are a key feature of floating rate debt. Uh, so I'll be jumping into that, but we'll give it just another minute and then I'll formally get started. All right, and this meeting will be recorded, and you guys will get an email shortly after, probably later this evening, with the recording. And if there's anything that comes up during the course of the discussion, some sort of document or link or anything like that, that will also be communicated in the follow up email as well. So I know people always ask, "Oh, I want the underwriting model that you used," or "I want this or that." We'll make sure to get links for everything that is requested in the follow up email. And if you haven't been on one of my webinars before, very casual, conversational. So feel free to jump in anytime via the chat or just unmuting yourself. But if you're not talking, please mute just to minimize background noise. All right, let's go ahead and get started. Okay, thanks everybody for joining. My name is Rob Beardsley, principal of Lone Star Capital. Today we're jumping into a fun topic, which is interest rate caps, which are a hedging product which allow you to put a ceiling on your interest rate exposure or interest rate risk on a floating rate loan. So people may be more familiar with an interest rate swap, which is where you take your floating rate loan and then you swap it for a fixed rate equivalent, and then you've completely taken interest rate risk out of the equation. A cap, or interest rate cap, is fairly similar, but you don't completely swap out the interest rate risk. You retain the interest rate risk exposure, but only up to a certain point. So you might set your ceiling at 5%, where today you're fluctuating somewhere around 3%. But if the rate ever goes above 5%, you're capped at that 5, and you effectively have moved into a fixed rate situation at that point in time. And there's some interesting nuances that we're going to get into, and specifically in how to model this into your underwriting. Maybe some people don't have this modeled into their underwriting at all, or you know, there's various ways you could go about it, and you could make the case for it. And so I'm going to present to you guys how we've gone about it and get some feedback, and maybe see if we can come away with some new insights. So first off, I guess what I'll share with you guys is the Pensford cap rate pricer, which this is not that. Hang on. Okay, so you guys should be seeing the Pensford rate cap pricer now. Let me know if you do not. But this is a great tool. I'm a big fan of Pensford. I read their newsletter weekly. What's his name? Uh, JT, I want to say. No, JP Conklin. So he writes a great newsletter all about interest rates and commercial real estate. Highly recommend it. So I hope that plug for him, he won't mind us using this tool for the purpose of this webinar. But anyway, this is a great calculator that they use, or that they provide. They update it on a weekly basis, so you can get really accurate rate cap pricing for yourself. And so I highly recommend this if you are pursuing deals, underwriting deals, and you are incorporating floating rate debt. Rather than being beholden to a hedge broker, you can just go ahead and pop in the terms here and get a great quote for yourself. So So the way that a cap works is there's a few key components, and let me zoom in just to make this easier for you guys. So we're looking at basically the few key components being number one, the notional, right? How much notional are we trying to hedge? And that would be the loan amount. And so really, when you're talking about a hedging product like this, it's agnostic to the underlying asset that the debt is financing. All it cares is, okay, you have a loan and it has a certain interest rate and terms, and then you're just going to purchase this hedge for that. So it doesn't matter if it's on a certain deal or anything like that. So all it matters is the notional and then the term that you want for the rate cap. So if you're going to do, let's say, a 2-year bridge loan, right, it obviously makes sense to have a 24-month cap to match the term of the bridge loan. Now, if you had, similarly, if you had a 3-year bridge loan, it would make sense to do a 3-year cap. And often a lender will require a certain term that they are asking for. Now, you might be getting a 3-year bridge loan, but be absolutely certain that you're going to flip out of the bridge or sell the property in 2 years. Maybe you can negotiate with the lender to get a 2-year term on the rate cap instead of 3. And that's actually a really interesting point, because Pensford actually put out a report very recently talking about this very thing, that while the vast majority of lenders, especially if you're talking about Freddie Mac floating rate loans that may be 10 years, even though it's a 10-year loan, they're going to ask you for a 36-month term cap. But what Pensford put out, and they said there's a lot of uncertainty. Obviously, no matter what environment you're in, the further out in the future you go, the more uncertainty there is. And obviously the bank or the counterparty that's going to trade with you on this hedge has to be compensated for uncertainty out into the future. So, and at this point in time, when you purchase a 3-year cap, even though the last 12 months, going from 24 to 36 months, is just a third of your term, it's like 2/3 of your cost, because it's pretty certain as to what's going to happen based on the Fed and market conditions in the next 24 months, but they really don't know in the next 24 months. So there's a good chance that if you buy a 24-month cap and then later in the future buy a 12-month cap, ending up at the same 36 months, you'll come out ahead than if you just to purchase a 36-month cap today. So we're actually in the process of closing a Freddie Mac floating rate loan, and we asked Freddie for an exception to do a 24-month cap instead of 36, so that we could capitalize on this reality. So that's the term. And on a 10-year loan, if you do buy a 24-month cap or 36-month cap, when it comes to expiration, you're going to have to buy a replacement cap. And lenders want, floating rate lenders, they want a cap on the loan for the life of the loan. So they can protect their downside and ensure that you can pay the loan in any circumstance. So it's the lenders taking risk away from them by taking the risk away from you and onto a counterparty. So typically the strikes are constant, which means you're picking a certain strike rate. And so what that means is, for example, on our Freddie Mac loan, it's a SOFR based loan, and SOFR today is 0.01%. So basically zero. But if we want to protect ourselves against SOFR going to 3%, we can choose a strike of 3%, so that while SOFR is nearly zero right now, if it goes to 3 and above, that's when the cap is going to go into the money, and we're going to actually start getting paid out by the counterparty and protecting us. So the tighter the strike, the more there's potential that the cap's actually going to kick in and provide you real value. So if we did a real tight strike, like 1%, you're going to see the price is going to go up, because there's a greater likelihood that this cap goes into the money and you're going to pay more. Similarly, 36 months out into the future, right, this cap rate, or this rate cap, is going to be much more expensive, $50K up to $174,000. So you can see how crazy the 24 to 36 months is right now, because as you guys know, the Fed is guiding to increase rates in about 24 months. So that's those are really the variables at play. And then, like I said, this is from what I've seen, I've done now three caps where I've done it myself, where I've priced it with Pensford and then went directly to a counterparty and said, here's that cost in the back of my mind based on the cap calculator here. And it came out to pretty much the same or better. So I was very happy with the calculator, kind of keeping me more of an informed participant in a situation where I really otherwise am not very knowledgeable about interest rate hedging. So that's what we have to work with here, and what we updated our underwriting model with. I'm going to jump over to the model now. So what we updated the model with is this new line item here, which is the rate cap cost and the strike. So this is pretty nifty stuff, and something that we should have implemented a while ago. We were just kind of, I was being lazy about it and was just kind of doing things manually, but finally I took the time, built this all out. So now the cap function actually works in our pro forma, and I'll explain what that means. So first here, this is the cost. So this is annoying going back and forth. I just need to share my screen. So first, if you go to the pricer, you can see the cost can be reflected as dollars, or you can reflect it as percent of notional, right? And now this cap is basically 70 basis points of your 25 million. So that's what we plug in here, which is as a percent of your notional. So, the cap that we're doing right now is roughly, because we're buying a 2.55% strike, not a 1% strike, right? We're allowing for more interest rate risk. The cap is roughly 30 basis points of our notional. So that's why I have this in here as a placeholder. And then the strike here I have set at 240, because with SOFR plus a spread. So just to take a step back, for those who aren't familiar with how a floating rate loan works, the two components for making up your all-in borrowing rate is the index rate, which in our case here is SOFR, plus a spread, which is added on top of that index rate. So today, for example, SOFR is at 0.01%. A common spread today for permanent floating rate loans is 2.6%. So your all-in borrowing cost would be 2.61%. But if SOFR goes up to 2.4%, add on your spread of 2.6, your all-in borrowing cost now is 5%. So looking at the pro forma now, I'll show you how this works. So we have first the SOFR forward curve. This is something that we've had in our model for a long time. And it is again, we go to Pensford, they update this daily, and we upload the forward curve, which is, and this is just showing by year, but we have every month, we have the market expectation for where SOFR is going to be. So if you look 10 years out, SOFR on average in year 10 is projected to be 2.24%. All right, and you can see what the market is expecting here. And this lets us accurately project, or at least accurately based on market forecasts, where our borrowing costs are going to be out into the future based on the forward curve. All right. Now, the next level is if the SOFR forward curve number exceeds our strike rate at any given time in our pro forma, it will essentially convert. We'll be maxed out at that ceiling, and we'll convert to a floating rate loan. So I'll kind of show how this works at, let's say, 1.5%. So I just changed the strike to 1.5%. And now you can see, where do we get to 1.5%? Well, we get to 1.5% somewhere around year 5. And if we zoom in, which I can do so by unlocking the sheet. If you're ever using my spreadsheet, by the way, there's no passwords. Just go to the review, unprotect sheet, and then have at it. So we press the 2 here to now break it out by month. So if we go over to year 5, let's see how this looks. So you can see we've been floating this whole time, right? So look at the borrowing, the debt service fluctuating every month, right? 70, 71. But then at some point we go to the SOFR curve hits 1.5 and then continues higher, right? But we have a strike of 1.5. So you can see now the debt service is stuck at the same number. We essentially have a fixed rate now because the forward curve has come into play, or rather the rate cap has come into play. And now it's that same number every month because, we're getting paid out. The difference of the additional borrowing cost is being paid out by the counterparty that we paid all that money to purchase the rate cap from to begin with. So that's how that works now. So if it ever comes into play and you're in the money, you get that protection. So, okay, I've been talking for a while, so let's take a stop. And I've got a question here, and then feel free to dive in with additional questions. So first question is, how do you determine which rate cap to use? So depending on the strike. So yeah, very good question, and that's kind of the most advanced question that we have here to potentially tackle today. But the first answer is, well, just use the strike that the lender requires you to use, right? And that's fine, that's fair. And that'll be likely the cheapest option that you have, right? Because you can't do any higher of a strike than the lender mandates, but you could certainly go lower and pay more. And then the question to pay more is really just based on your risk tolerance and your crystal ball as far as what you think interest rates are going to do. But if you look at the data, and this is now getting more speculative, and we're getting more into the open discussion, but if you look at the historical data, which also Pensford does a good job of walking through, you can see that in the end, floating naked with no protection over 2-year periods, 5-year periods, 10-year periods throughout various cycles typically wins out as being the cheaper option over fixed rate financing. So in my opinion, a rate cap, thus far we've only purchased rate caps at the minimum requirement of the lender and haven't gotten too creative as far as trying to buy really tight strikes. But we can look at, if there's time at the end, to do something really interesting, which is to kind of manufacture a fixed rate by buying a super tight strike. And we can kind of compare the fixed rate equivalent, because essentially the idea there would be, can you buy a rate cap on a floating rate loan and then essentially have the same all-in borrowing cost when you factor in the price of the cap as the fixed rate equivalent? But the benefit of the floater there is you've got the 1% exit fee versus yield maintenance on the floating rate, on the fixed rate side, right? So that's a huge benefit of being able to borrow on a floating rate basis, is you get that really great flexible 1% exit prepayment penalty. Whereas on a fixed rate loan, most commonly you see yield maintenance, which is very onerous and can kind of put you in a corner as far as being able to exit the loan. So that's really the primary reason that attracts us to floating rate debt, is just the flexibility of exit. If we have a deal that is value add, but maybe we're going to hold it for 2 years, maybe 7 years, we don't really know, but we also don't want to take bridge loan risk, then that Freddie Mac floater is a perfect product for it. But at the same time, if you want to take out interest rate risk and you have a more cash flow driven investment strategy, then the fixed rate makes a lot of sense, especially today where you can guarantee for 10 years, lock in that low rate, and now you've guaranteed that cash flow, right? You're already taking your NOI risk. You don't need to take below the line risk on the interest rate. So there's two strong arguments there. The other really interesting thing here is that to be considered is, what about buying down the prepayment penalty on a fixed rate loan? So if you're not familiar with that, you do have the option of actually, instead of a yield maintenance prepayment penalty on a fixed rate loan, you could pay extra, maybe something like 30, 40 basis points more on the debt, and you can get a step down prepayment penalty of, let's say on a 10-year loan, the yearly prepayment penalty declines as follows: 5, 5, 4, 4, 3, 3, and so on. So it really becomes more economic after the first 4 years or so. So better than nothing. But it's not that simple, because when you do buy down the prepayment penalty and you pay that extra rate, let's say your fixed rate goes from 3.25 to 3.6. Now your loan has to be sized based on that higher interest rate on a debt service coverage ratio basis. And since cap rates are just so low today, every deal is DSCR constrained. So every increase in interest rate puts pressure on your LTV. So if you're a leverage sensitive borrower, you don't want to do that to yourself and risk losing 5 points of leverage just because you wanted to buy down the prepayment penalty on the fixed rate. So on the floater, right, you can size to the lowest fixed rate equivalent and then buy a cap and kind of get the best of both worlds if the numbers really work out. So we can look at that shortly. So yeah, So good stuff. So the next thing is we've got, obviously, we have to, the rate cap isn't free, as you guys saw. It can be quite expensive, especially if you tighten up the strike. So you have to, if we are going to go down this path and do this analysis, we have to factor in the cost of the cap into our interest rate to kind of come up with an all-in rate. So if, like, for example, if we're buying a 3-year rate cap and it's costing us, let's say, 30 basis points, right? You could take that 30 basis points and then spread that over 3 years and then essentially add 10 basis points into your interest rate. So if you're borrowing on a floating rate basis at 2.5, your actual interest rate is 2.6 when you factor in the rate cap. But unfortunately, it gets more complicated still because we have to buy a replacement cap for when that cap expires. And so we built in this rate cap replacement escrow, which lives on for the life of the deal, right? Which makes sense. The lender actually makes you on a permanent debt deal where the rate cap on acquisition is not coterminous with the term of the debt. You actually have to, from month one, escrow the estimated cost for the new cap upon replacement. And so that's what we built in here. We did, we didn't go too complicated with the formula. We just basically said that the future cap is going to be somewhere around 150% of the cost of the acquisition cap. And then we just escrow that on a monthly basis. And the trick here is, since we're assuming that the first year cap, the acquisition cap is 36 months, then all follow along caps will be 24 months. We have essentially the first 3 years to escrow for a 2-year cap. So that's why you see the first 3 years are a smaller escrow of 18,000. But then once that ends, then every year you've got the 28,000 escrow because you only have 2 years to escrow for the 2-year cap. So hopefully that makes sense. So building this in below the line, this doesn't affect your NOI, right? So it doesn't affect the property's value because it's a below the line expense, but nevertheless, it's going to obviously affect your cash flow, and you want to have this factored in so you don't have an unrealistic assumption about your cash flow potential. Not to get too off topic, but a similar situation is, first, number one, we've got replacement reserves, right? And hopefully you guys are factoring that in my opinion, above the line, because a lender requires it. Every deal has it. It's a pretty standard expense. And all the institutional guys I've talked to, they all put it above the line. So it does impact your NOI, which of course does impact your valuation. So when you project to sell, you're basing it on terminal NOI, which could be your year 5 NOI, which is impacted by the replacement reserve. So, but what we added also is a recurring capital expenditures line, which is below the line. So again, it hurts our cash flow, doesn't hurt our valuation, but we feel, especially for older property, but even for newer property, it's good to have this additional ongoing expense to factor in, just so that, if you don't use it, great, it benefits your cash flow. But if you need it, it's budgeted for, and you're not, overselling your cash flow and not accounting for things that inevitably come up as unexpected expenses. So not to get too off topic, but the rate cap replacement escrow falls under that category of below the line escrows or expenses that you need to factor in for a realistic cash flow. So the other thing that was interesting while putting this together is the reimbursement or the release of these escrows when you sell, right? So if you were to do a 3-year hold and you actually never end up buying that cap, well, all this money that you escrowed just gets refunded to you, right? So that's a positive. But on a cash flow basis, it impacted your cash on cash. But at the end of the day, the money came back to you and you get to, get it back. So you're only really hurt marginally on an IRR basis due to the time value of money, and you're hurt, a decent bit on the cash flow basis. But if you are, let's say, underwriting a traditional 5-year hold, this money here is ending up going to be purchasing the second rate cap, but this money that you escrowed will refund back to you. So we factored that into our reversion analysis as far as the closing costs associated with sale, that, we get this money back on a 5-year, and we get this money back on a 3-year sale. So hopefully that all makes sense. I think this is a great improvement and something that we've gotten more and more committed to the floating rate side. Not to say we'll never be a fixed rate borrower, but we do like it, and it matches our business plans well. So we wanted to get smarter with the way that we're projecting this and doing that kind of stuff. So yeah, so at this point I'll encourage more questions and discussion. So question from Kenneth here: is the rate cap payment one time in the beginning of the loan or an annual requirement? So great question. So the rate cap, the way it actually works is you usually buy this rate cap from a counterparty. So you don't buy it from the lender, you buy it from a certain hedge provider. There's really not that many out there. And of the universe of cap providers that are Freddie Mac or Fannie Mae approved is even smaller. And then of that list, those of that list, the ones that are willing to do business with you if you don't have a pre-existing banking relationship or something like that is even smaller. So for us, we kind of figured it that SMBC Capital Markets. I'll put it in the chat if you guys want to get in touch with them. They're kind of the player to transact with for these rate caps, just because they're good with Freddie, they're good with you, and they're easy to work with. So that's who we've been transacting with. So anyway, a day or two before closing the actual loan, you go and buy this rate cap from them, and you pay it all up front. Here's 50 grand, and then you buy that cap, and that's how it works. But then the lender is going to, on a monthly basis, along with all their other escrows, is going to require you to escrow the cost of the future cap to buy. That's on a monthly basis, but the actual payment is a one-time payment. So the way it'd work is the lender would escrow it, then they'd have that money sitting there in escrow when it's time to buy the new one, and then you'd use the funds, and obviously you'd have to go out of pocket if there's an overage there. And lenders are supposed to, not always, but they're supposed to do a good job of doing escrow analyses where they're actually, kind of making a prediction about what the cost will be in the future, and then making the appropriate escrow amount. But, often they're wrong. I'm sure you guys have experienced it where lenders escrowing for property taxes come due, and they're way different, and you have to come out of pocket and things like that. So, just another reason why it's good to have, recurring capital expenditures baked in, or just extra reserves on hand and things like that. All right, cool. Well, any other questions? We blazed through this, I think, pretty quickly.
Hey, Rob, I have a question if you don't mind, and it's probably easier to ask versus type. And it's a little bit off topic. I hope you don't mind. So on the replacement reserve, so line 27, right? So the whole discussion about above the line, below the line. I mean, at the end of the day, it shouldn't matter, because at exit, when you calculate sort of like your exit price, you would need to add that back to the NOI. Is that how you would do it, or how do you think about that?
Yeah, it's a good question. So, yeah, let me explain that. So the way that it works is, quite simply, we're going to take our year 5 NOI, which just happens to be this row 31 here. And I'm not sure if you can see my spotlight. I think you can. But if we just take that number and divide it by our cap rate, which, let's just say is a 5 cap, the exit price that we're going to project is going to be 19 million. All right. There's no adding back or taking away or anything like that. It's just, a reversion analysis based on your NOI at that time. So it's, arguably there's no right or wrong. You could make the case and say, well, I'm just going to move replacement reserves below the line. I also see franchise taxes below the line, which franchise taxes are a Texas thing, and you have to pay them no matter what. So I don't see how they could not be an operating expense, right? But the more things you move below the line, the better your NOI looks, and then the higher your price looks. But that doesn't, it's not, you're not actually making money. You're just making a certain prediction about pricing, and it's the methodology of the pricing. And if you underwrite all your deals a certain way, that's fine, because it's going to be apples to apples. But if I show you one deal that has a certain IRR or a certain sales price, and I'm using a certain methodology, and then a different deal with a different methodology, we can't compare the two. And it loses its meaning. So I think most importantly is just to keep things consistent. And so for us, we've chosen to have replacement reserves above the line and have it, impact our sale value. Also, when we underwrite a deal, right, the seller or the broker might say this deal's a 5 cap, which today is a great deal. But we might underwrite it and it might be a 4 cap because we're going to adjust, because the seller might not be including the replacement reserve in their NOI. They also might not be including franchise taxes, and they might have a lower property tax number than what we're going to project. Or maybe the seller runs it for really cheap payroll and we're going to add additional payroll. So, that's why it's important to layer in all the things that you do and keep it consistent. Hopefully that makes sense.
Yeah, thank you.
So Tyler has a question. Is the general consensus for lenders or SMBC that SOFR has taken the place of LIBOR? So yeah, there is a strong push to move to LIBOR, and because Fannie Mae and Freddie Mac are government-sponsored enterprises, they are leading the way. And so most people are not doing SOFR yet, but if you're doing something with Freddie Mac, it's going to be SOFR. And like I said, they're trying to lead the way, and there is definitely resistance. And the cap market is not as liquid for SOFR than it is for LIBOR, right? There's just less transactions, less things happening in that space. So you have to pay more for a SOFR cap right now than LIBOR, unfortunately. So that's something to be aware of as well. But they're pretty much the same, and it's going to happen. It's just going to be a messy transition. But how else can you make it happen? How else can you move an index rate that currently has trillions of dollars attached to it and make it not messy? So I think they're doing a pretty good job. And at the end of the day, Freddie is lending at pretty low rates today. So the extra cost of SOFR, rate caps, or anything like that is nominal. Also, every lender today, even if there is resistance, is baking into their loan documents a index replacement clause. So if it's a LIBOR loan, there's already language in place in the loan docs that say, in the event that LIBOR is discontinued, we're going to transition to SOFR, and here's the adjustment that it's going to make. I don't know all the nuances of that. Pensford has definitely talked about this. And so if you're interested, you could look into what they have to say about it and what you should be looking for in your loan docs.
Hey, Rob, I'm just wondering, is this your default strategy when you're doing an initial underwriting? Are you moving right to the rate cap replacement model?
Yes. Yeah. So today, and obviously it could change, but today our default, and I'll go to the inputs. Our default is a floating rate permanent loan. Like we wouldn't not do a bridge loan today, but we see a lot of people doing bridge loans today for the wrong reasons. They're just picking up extra leverage. Bridge loans are cheap, and that's partially pushing pricing up today, unfortunately. But for us, we're only going to do a bridge loan if the deal needs it, if the deal really has enough lift. So our first, and those deals are rare, right? It's not every day that you find a deal that really has a ton of upside and maybe big vacancy and things like that. So our first step is a 10-year Freddie Mac floating rate loan, because that's the our value add strategy, which we underwrite to a 5-year hold. Really could be a strategy where we are doing a refi in 3 years, selling in 3 years, or holding longer if we need to. And that's why the 10-year loan term is great. But the most important part is the prepayment flexibility, right? It's hard to honestly tell your investors, this is a 5-year hold. We're going to be opportunistic. We might sell early, we might sell later. But then if you have yield maintenance, you have to factor that in somewhere. So the floater, has its own complications, but it definitely works around the prepayment issue. And like I said before, so what's interesting is typically when you look at a pro forma, you see cash flow get bigger year over year, right? Unless interest only payments expire and then your cash flow goes down. But what we're seeing in our pro formas is because we have the forward curve in there, and it gets bigger over time, the cash flow actually goes down, from year 4 to year 5, just because of this pretty big jump in the forward curve. Whether this is right or wrong, who knows, but this is what the market is saying today. So that's what we're going with. And so we're seeing a lot of deals based on a floating rate basis. We really don't want to do a deal that when the amortization kicks in, the cash flow is below 5%. I mean, really, it'd be better to be 5.5%, 6%. But if we really like the deal, the lowest we would go is 5% amortizing cash flow. And when your rate goes up like this so substantially, it's harder to do. So that's why when we're looking at a deal that is really a cash flow driven play, like let's say it's newer vintage, it's not really value add, we're just buying it because we are attracted by the location and the long-term cash flow, that's where we'd maybe lean towards like underwriting a 7-year hold with a fixed rate loan, because it's actually going to show that better cash flow over that period, because we're going to lock in a low to mid 3s today. So that's how we're kind of looking at it. Okay, so if there are no more questions right now, again, feel free to jump in anytime, but we'll take this last minute to look at the scenario of, let's say what's the cost of buying a really tight strike. And see, the thing that's hard about this example also is the variability of the replacement cost of the cap. Because if we want to buy a 1% cap, and in 36 months SOFR is over 1%, buying a 1% SOFR cap is going to be incredibly expensive, because it'd be in the money day one. And it basically, like, you're just paying the full floating rate amount. So this isn't the most applicable argument, but just as an example, like if we take also by the way, it's not recommended to ever buy a cap more than 3 years, because the market out there is just very uncertain, not liquid, and you're just going to pay an unreasonable premium for that. Like we could try 48, and you can see it jumps to, I think that was almost triple the price for just another 12 months. So I think the most liquid cap is 36 months. That's probably because it matches the term of bridge loans, and because that's the mandated minimum term for Freddie Mac. So what we can see here is we can look at, so today, for example, you can borrow. So SOFR today is, they've got this thing locked. Let's see, I'll open another tab. So SOFR today is 0.01. 0.01. And spreads are, around, oh my gosh. This thing's so slow. Heavy spreadsheet they've got. So 2.6% is what we're going to go with on the spread. It's going to take too long to explain. I'm sorry, guys. This is so slow. Okay, anyway, so I'll just walk through it, and then we can maybe put numbers to it. So basically, the idea is if today we can borrow a floating rate at 2.5%-ish, and fixed rates are 3.25%, right? So let's say there's a 75 basis point spread today between the prices. So that means if we kind of goal seek for that difference, that's a big difference actually. So if we say that we want a 1% strike, well, let's do a 75 basis point strike. So but the reason why I'm using 75 basis points is because SOFR is pretty much zero today. So if SOFR goes up by 75 bips, now you're pretty much floating at what you could have locked to begin with, right? And so for the first 36 months to do so only costs you 74 basis points. So if you take 74 divide by 3, you're adding another 25. Sorry for my lack of mental math, But if you add on another 25 basis points to your floater of 2.5%, right? So now your actual borrowing cost is 275. You essentially are still doing better than just having had fixed from the beginning at 3.25, right? It's cheaper, and you'll just let yourself over time as SOFR moves higher, supposedly, then you will end up fixing there at that point by the fixed rate equivalent that you had back then. But again, that's only valid for the first 36 months. So if you're a long-term holder, you're going to have to again factor in that recurring cost of replacement. And of course, like I said, if SOFR is higher at that time and you want to buy the same strike, it's going to be considerably more expensive of a cap. So the math gets wonkier. I would love personally to learn more about how these pricing models work so that I could get smarter about factoring in the potential future cost of the cap so that I'm not just making a simple approximation of, oh, well, it's going to be 150% of the cost of the original. That would be quite interesting and help to make a more robust analysis of actually trying to get smarter with the strikes, which somebody asked about earlier, which is really the great point here is how do we determine which strike we should use on these caps. So until then, I'll just keep on buying the minimum. So yeah, thanks guys for joining. Hopefully this was a good discussion. We can stick around for another few minutes and just discuss anything about this topic or just anything in general while we're all here.
Rob, I have a quick question.
Yeah.
You said like the bank, will the bank make you get if you take a floater, will the bank make you get a cap or no?
Yes, they'll make you.
And so say your business plan is like you take a floater for 3 years while you bring it, you stabilize it, get up to 90. So your long-term plan is to hold it, get fixed rate debt. Will you have to buy another cap at 36? Even though I understand you're escorted, even though you plan to refinance in the next 1 to 2 years, or will only go away when you refinance?
Yes, that's a really good point. So, and this is the great flexibility of the floater, right? Like you said, if your business plan is transitional and you want to bring up the value of the property and then you maybe want to exit or refi, you want to have that flexibility. And so, but you don't want to buy a fresh cap and then sell right away, right? And then just that cap is worthless. It's gone. So what you can do is if you are, your initial cap is, let's say 36 months, and then you're doing your business plan, you're hoping to refi, but let's say you can't refi in time and then, you need to buy a cap. You could just buy a 12-month cap after the first 36-month cap. And then during that 12-month period, you could work on a refi, you could work on a sale, and you could have that, so you don't have to buy another 36-month cap and do that. And again, with the floating rate loan, right, after 3 years, you can exit for 1%. Or maybe if you refi with the same lender, maybe you can get it waived depending on the product. So that would be my strategy. Or if it's a timing issue of a matter of months, maybe you could just talk to the lender and say, hey, I know my cap's expiring here, but I've got this refi in process. It's going to be done. Can you waive the cap requirement? That would be my first goal if it were a matter of months.
Say it's a year. Do you have to, or like you notice during your 3 years, like that you think interest rates are going to be more steady or whatever? Do you have to take the same strike on the follow-on terms?
So I believe that the minimum strike they set from the outset is the minimum strike required throughout the entire term. Yeah.
Okay.
But no problem. And the reason why they are doing that is because they're looking at their risk models and they're looking at the DSCR, or essentially the property's NOI versus that max rate at the cap, and this if you can still break even there, or ideally cash flow, they're happy. They want to make sure that they can continue to get paid on their debt, and that you're not going to become unable to pay because the rate goes up above a certain thing. And that's why the cap is there. Okay, guys, any other questions? All right, cool. Well, hopefully this was helpful. Again, I'm doing stuff that's relevant to me today. I don't like talking about the basics. So, I appreciate you guys letting me jump right into something that's, relevant to all of us right now. And reach out if you have any questions, and look out for the replay email, and I'll see you guys next time.